Chapter 7, Learning Target 3 for the CP Accounting class, discuss the impact of closing events on the accounting equation and demonstrate and make post-closing journal entries. One of the things before we start off is we need to talk about what closing entries are. This is towards the end of the accounting cycle. Entries are made to zero out income statement accounts and transfer their balances to owner's equity. To close, so basically we have certain accounts such as our 400 and 500 accounts. We need to reset them to zero to begin the next fiscal period. In order to reset them to zero, we do the process which is called closing entries. To close a revenue account, you're going to do the opposite of the normal balance to make it zero. So a revenue account's going to have a normal balance of a credit. So therefore, to close a revenue account, you're going to debit it, and then you're ultimately going to credit retained earnings. A credit to retained earnings means net income. To close an expense, you're going to credit it. You're going to do the opposite of the normal balance to close an expense, and then you're going to debit retained earnings. Okay, so we got two different things we want to talk about. First, though, is we want to talk about there's permanent and temporary accounts. Permanent accounts are an asset, liability, or owner's equity account whose balance is carried over from year to year. Temporary accounts, on the other hand, are revenue and expense accounts which need to be zeroed at the end of the fiscal period. This is any expense account. This is going to be your revenue accounts. Now, not to be confused with unearned revenue. Unearned revenue is a liability account, and unearned revenue does not get zeroed out. Rather, that unearned revenue will get carried over from year to year. Once again, that's that accrued revenue that we talked about in a previous lesson. So temporary accounts are your 400 and 500 accounts. Permanent accounts are going to be your 100, 200, and 300 accounts, or your assets, liabilities, and owner's equity. So let's take a look real quick. So we got our adjusted trial balance here for this business. Notice we're going to get rid of our assets or liabilities and owner's equity. We're really not going to deal with them. We're going to go straight here with our revenue and expenses. So basically, think about taking your income statement. You got to close everything out that's in your income statement. So what we're going to do is we're going to take our service fee revenue, which is $5,800. I'm not going to close out retained earnings yet. I will eventually, but I'm not going to do it yet. So I'm going to take my service fee earned. I'm going to have to debit it, and then I'm going to have to credit it. In order to move it into retained earnings, I credit it to $5,800. Retained earnings is an owner's equity account. A credit is a normal balance there. It shows an increase in the worth there. Now, if we had a net loss, then that's a different story. So now what I'm going to do is I'm just going to do the opposite. If you notice here, all my expenses have debit balances. Therefore, since they have debit balances, I'm going to do the opposite to make them zero. I'm going to credit them, and the total then will go into retained earnings for $1,400. And now I have reset all of them back to zero. Think of a closing balance as a resetting the odometer before you start a trip, so you know how far you've gone. If you don't reset them, how do you know what your supplies expense were this period as compared to next? You need to reset them. Let's take a look at another one here. So this is Murphy's Tax Services. There's their adjusted trial balance. So let's take a look and let's close out these accounts. Well, what are their revenue? We want to take their revenue less expenses to get net income, right? So we don't need their first ones because those are the permanent accounts. They don't get closed, so we're not going to deal with them. So we're going to take our revenue. In this case, Murphy's Taxi Service called their revenue account passenger fee revenue of $4,250. Our expenses are going to be $2,400, $485, $650. And $160. So then basically they have a net income of $590. So our ending retained earnings, so in this case you see like our retained earnings is $3,270. Our ending retained earnings, is basically going to be $3,270, and that's going to be on our adjusted trial balance. It's going to be $3,270 plus our net income that we just calculated of $590 will give us an ending retained earnings of $3,860. Now, let's take a look here. Given the fiscal year, Aaron Distributing needs to prepare its financial statements. So given the following trial balance, prepare the income statement and statement of retained earnings for the year ended December 31st, 2003. Dividends of $1,000 were paid during the year and reflected in the trial balance. There was no additional capital stocks transaction. So once again, we're only when we're looking at when we want to prepare the closing entries for Aaron, we want to only look at the revenue and expenses to close them. So on December 31st, when we're closing it, we're going to debit fees earned and we're going to credit to income summary. Income summary is a very comparable account to retained earnings. Okay. Next, we're going to take our expenses. We're going to credit them. We're going to list up all of our expenses, and then we're going to just debit the total of them into income summary. Income summary is also a temporary account that's oftentimes used in place of retained earnings. It really kind of depends on what kind of system you use, but income summary is oftentimes used as well. Okay. And then on the 31st, we then take our income summary into retained earnings. Why you use income summary instead of retained earnings? It's a preference. In income summary, for the most part, is going to keep things a little more organized and a little more orderly, so you can have more of a story on it. But it's really kind of a